Lately, the drums have been beating more loudly that a new bear market in bonds is at hand. The yield on the 10-year Treasury note has risen from 2.43% at the beginning of the year to around 2.9% now, and that's a big move in a short period of time. If you recall, bond yields move the opposite way from prices, so a big jump in yields like this means a lot of people are selling bonds. But why? Well, fear of inflation and how the Federal Reserve might react. New Fed Chairman Powell shook up markets by appearing to hint during congressional testimony that the central bank might consider 4 hikes in the federal funds rate this year rather than the expected 3. The Dow Jones Industrial Average lost nearly 300 points, while the S&P 500 shed more than 50 points that day. The bond market's declines have prompted some high-profile managers like Jeffrey Gundlach and Bill Gross to declare the 35-year-long bull market in bonds is over. The bull market took 10-year Treasury yields from 19.1% in 1991 all the way down to 1.38% in July of 2016. Gundlach and Gross argue the recent spike in yields breaks the back of the multi-decade bullish run. Others have also said a bear market in bonds would kick in at a 10-year yield of about 2.6 to 2.7%. But I think they're all wrong, way wrong. First of all, Gundlach said bonds faced a moment of truth when the 10-year Treasury yield topped 2.4% last October, while Gross declared the bond bull market over back in 2013, 2014, and 2015. He's a broken record. Second, 10-year yields topped 3% in December 2013, only to plunge again later. By my reading of the charts, the true breaking point for the bond bull is somewhere over 3%, and yields have to stay there a while for this to become a real bear market. Third, economic growth is picking up, but in 2017, GDP grew by less than 3% a year. GDP growth averaged almost 6% annually during the 1960s. So this economy is far from overheating. Finally, fear of the Fed is way overblown. The tax cuts and spending bills passed by Congress should help stimulate the economy, but will leave trillion-dollar deficits as far as we can see. The government's greater financial need may push rates higher over time, but I don't see a spike anytime soon. Mark Kissel, who is PIMCO's chief investment officer of global credit, told Bloomberg recently he'd even consider buying bonds if the 10-year yield hits 3%. I think he's right. And my opinion is that the stock market is peaking, and high bond yields will help snap the 9-year bull market. In this video, we're going to talk about current conditions, and we will discuss some of the issues facing a potential bond bull market. And this video is titled Crash Course because we are going to have a quick, concise conversation about a lot of important issues that I will throw at you very fast. And secondly, because I believe we are on a course to a stock market crash. That's a potential crash. And in my opinion, if the crash occurs, bonds will then launch into a bull market. And the next video is called The Next Bull Market. In that video, we will look closely at bonds and the issues to help support my conclusion. Even though bonds may sound boring, to me, making money while the stock market is going down is not boring. You may also learn a few interesting lessons. So let's take a look. A popular argument against bonds is that the economy is heating up. But recently, the European Central Bank chief Mario Drago conceded that the growth cycle may have peaked. Of course, those paying attention to the data already knew this. Our politicians and central planners have been peddling to us the fantasy that the global economy is strengthening, finally ready to fire on all cylinders after nearly 10 years of dependency on monetary stimulus. And it just isn't so. As you can see here by this chart, the Federal Reserve of Atlanta's GDP Now measure, which gives a forecast of Q1 2018's expected GDP, is currently coming in at 2%, down from the much higher 5.4% growth predicted as recently as February. And that's ridiculous to have a prediction cut in half in such a short period of time. And that 2% growth, generating that growth, a meager 2%, has required a tremendous amount of new debt. So much so that the U.S. will have a worse debt to GDP ratio than Italy. There is no truth to growth. That is not an argument. Let's go to the next chart. And you've seen versions of this chart before that I've showed you, and this goes back to prior to 1970. And it shows you essentially what I'm saying is that the GDP is minimal at best. And going back to 1970, if you take a look at GDP and you subtract out the federal debt, you see that something broke in the great financial crisis back in 2008. At that point in time, we peaked. But since then, it's been down below zero. We have no growth. We have lots of money being thrown at the economy with very little results. Let's go to the next chart. In this chart here is the GDP growth, or the synchronized GDP growth, from the three largest developed regions in the world. So not only is growth decelerating in the US, but it's also decelerating in Europe and in Japan. So to summarize, in my opinion, growth is not an issue. Actually, we have a lack of growth. So let's go to the next chart. Another popular argument against a bond bull market is that inflation is picking up, and with a pickup in inflation, bond yields also have to rise. But looking here at this 55-year chart of inflation going back to 1965, we can see here these red X's. These are the inflation peaks, and these peaks occur when recessions occur. So since 1980, the peak at this point in here, the trend has been decidedly negative all the way down through the current time frame. And even though inflation may have been picking up since about early 2015, the rate where we are at today is still relatively low and relatively moderate. So number one, the overall trend is still decidedly negative, and I believe, as I've indicated in previous videos, that we are nearing recessionary conditions. So let's go take another look at some more information supporting the lack of inflation. We looked at this chart here recently, and this is the chart of velocity of money. And as I indicated to you before, the velocity of money is essentially churning of the money in the economy. And when you have a positive velocity, you have growth in GDP, and inflation. There is a link to inflation. It may not be causal, but it is a correlation. So with negative or declining velocity of money, declining of the churning of money, we have a decline in GDP and also an indication of a decline in inflation. And let me show you why. Although we have not talked about this concept before, but this has to do with demographics and labor force and overall population growth. In my opinion, and the opinion of several others, the reason that we have deflationary conditions is that the labor force in much of the world is declining. And although here in the United States we have a growing labor force, that's going to set us apart from the rest of the world, particularly China, Europe, and Japan. However, our growth is not going to be able to offset the overall decline in population and labor force throughout the rest of the world. Let's go to the next chart. And the last valid argument against a bond bull market is that the Fed, Bank of England, the European Central Bank, and the Bank of Japan, as well as the Chinese bank, their balance sheets are expected to decline. And that is a forecast. But that forecast came in, say, late 2017, and as of today, not much has happened. There has been some tapering, but not significant. And to me, that is proof of weak economic conditions. And if I'm right, and conditions are weak in the economy, and if we do have perhaps a strong correction, maybe a stock market crash or collapse, we will likely have a delay in further tapering. If there is a stock market crash or collapse, maybe the central banks will again intervene, pushing yield rates lower. In my opinion, the probability of negative yield rates is increasing. And as we'll discuss in the next video, there is already about $10 trillion of investments in negative yields. Economists have warned that the combination of Trump protectionism, big tax cuts, and uncontrolled government borrowing, which is coming at a time when the U.S. economy is already near full employment, will ultimately fuel inflationary pressure. But financial markets simply do not believe this message, as indicated by this yield chart here. The flattening of the curve, to me, is strong proof of otherwise. And as Trump ratchets up his trade war with China and the Federal Reserve Board increases U.S. interest rates, the prospect for the world economy and financial markets, which was bright, very bright, just a few months ago, now appears to be darkening. Stock markets around the world have fallen back toward their February lows. Business confidence has weakened in Europe and much of Asia. These events, to me, are a prelude to a weaker market, setting the stage for a bond bull market. So please join me in the next video and further explore the next bull market. So for today, that's ChewDog Charts. Thank you.